Hello and welcome to your Wednesday dose of wealth wisdom. I'm not going to share it today because the signal is pretty bad in my house, so I reckon there'll be quite a few bugs and dropouts if I do that. So I'm going to be sharing it after I do the recording. So we'll be beginning right away. Let's begin. Hello and welcome to your Wednesday dose of wealth wisdom. With me, Daniel Kennedy, your host, Steadfast Construction and Design founder, KML Group founder, HomeHook founder, and Wealth Dragon coach. Today's topic is rent-to-rent HMOs are a very short-term answer to a long-term problem. And what do I mean by that? So, first of all, rent-to-rent, let me just clarify for those of you who don't know, are when you go up to a landlord and you typically would take his tired property, invest a couple of £1,000 in it to try and get it looking, not actually being, but looking well, because the difference between looking and being is very different, and we'll clarify that later. You then rent that HMO out at a premium, or alternatively, you'd put in fire doors, you would put in some furniture, and you might invest a little bit to get a higher return, and that's typically a few business models. And the reason why this is so successful is because the barrier to entry from this is very, very low. So what does that mean? That means you don't need a lot of money to start doing rent-to-rent HMOs, and it's a really, really easy sell for people who want to say, like, you can get rich in a year, you can get 50 rent-to-rent HMOs, because it's very scalable very quickly. But the drawback is the difference between developing the skills of raising finance, developing the sort of brand where you're able to raise finance and do your own deals and invest your own money in your deals, like making them good rather than just making them look good. You're actually doing the being part. You'll invest more in your HMOs. That the whole different mind frame is very different, because if they're yours, you're going to be more willing to spend that extra bit more on the boiler. You're going to be more willing to spend to restore the Minton floors, perhaps, because you are going to benefit from the increased value. What I find on HMOs, which are rent to rent, and I've only seen one HMO that I actually like, but rent to rent HMOs have been absolute debacles. Every single one I've looked at, I've been like, how are you letting these rooms out? And the model seems to be you have to trick the tenants to signing a contract, and there's a very high turnover because you're trying to bleed as much cash out of that property as you can because the margins are so slim. So there's a few big trainers out there who will tell you that rent to rent is a great way to get into property and that you can earn lots of money doing rent to rent. And the reality is, and no, like, for the amount of work that you put into managing a HMO, getting a HMO, is and to get such a small thin margin, typically it'll be between 1,500 quid if it's good, or more than 500 quid tends to be the deals that I see that are out and about. And for the amount of work, it's just not worth it. You might as well go stay in your day job, because pound for pound, hour for hour, you're probably earning more. And the tendency with rent-to-rent HMOs, you'll notice no one's a long-term rent-to-rent HMO. They build a big portfolio, they split it off because they realize it doesn't make that much money. I know somebody who had a portfolio of 50 and was just expanding, then looked closer at the numbers, weren't making any money. Someone in Birmingham who recently sold off all the portfolio because it was too much stress versus the money, and they may as well have been in a normal job. And just look at the industry of who has the fabulous properties, who has the really high rents. It's the people who own the bloody assets. So you are going to waste time trying to beg for landlords to give you these deals. You're going to put all this effort into them. You're probably going to have a shit product to begin with and just have to put glitter on a piece of shit because the inner workings of the HMO is crap, and you don't want to invest money in a new boiler and money in rewiring the sockets, money in making sure that the flow into the property is adequate for the amount of showers that are in there. You're not going to want to do that on a rent-to-rent basis. And why would you? You don't own the asset. And any long-term wealth for property is built by having an asset that beats inflation. The cash flow is minuscule in comparison to having the asset go up over time and inflation eating away at the debt. That's the whole how most people make their wealth, is by putting their money in assets. And rent-to-rent, you're wasting time. You're treading water. You're exchanging one job for another. You don't own the asset. You're getting experience managing. That's the only plus. And the only thing that I would have in the pro rent to rent sort of, if I started again, I would maybe look at rent to rent for the only reason of positioning myself as somebody who knows what they're doing to be able to raise finance. I would accept the fact that I'm probably not going to make much money on rent to rent. I would accept that eventually I would have to let that asset or let that liability go awry. And when you look closely at the people who are saying you must do rent to rent, you'll notice that they're not talking about their own deals. You'll see, like, the people who own them and the people who are proud to show them off generally tend to be the people who are going out purchasing, raising the finance, and then putting everything and all the design works and everything that they want to into these HMOs. And most of them will show you off. No one will do development tours on rent-to-rent portfolios. I haven't seen one, and you know why? It's because most of them are absolute crap. And they're doing the bare minimum just to try and extract the most money out of the asset. And that model isn't sustainable. You've got nowhere to go when the market becomes saturated. But for the people that have put a bit more effort into their HMOs, they can drop the prices and still be profitable. When you own a HMO, although it's really, really difficult, I understand to raise finance. Some people aren't as good at it as others. And typically for me, my model, I don't see any money from a HMO for 4 years because we raise the money, do it, and then the margins are so good, we're able to pay back the investors within 2 to 4 years. I was hoping it's 2, but more often than not that it's 4. And then at the end of that, we get a HMO that you own. So I would implore you guys to source deals because you're going to need that skill anyway. That's what you should be focusing on. You shouldn't be doing rent to rents. It's a short-term problem. And at the end of this portfolio, when you've wasted 2 or 3 years, you're working all hours God sends because the margins are so thin, you can't afford to employ somebody to buy your time back, and you're just treading water, because that's what happens. People just can't afford to scale to a place where someone else can manage it for them and they make money. Apart from the social housing model, I've heard some good things about that, and that may be something that I'll explore in the future. But I think you should be spending your time sourcing, really focusing on finding the deals, connecting with the investors, because then what's going to happen when you get good at this, people will be knocking on your door and you'll be able to say, no, I'm not going to source it on, but how about you lend me 25,000? And that's typically how I started. And we sourced loads of deals. We got positioned ourselves as somebody who could be approached to get deals from, and then we were able to raise finance. And when you get the skill of raising finance, the world is your oyster. The only thing that's stopping you is your own ability to say, nah, I can't be asked to do that deal. So you can say no to the funds, because we say no to way more money than we say yes to. And that's purely because of this sort of public profile, us being so open with all the mistakes, us being able to source and control the assets and talk about our lessons about those assets. So start sourcing and start raising finance. No one's going to give you money in the first year. Just accept that. You're going to have to really, really labor and put lots of effort and value into those relationships before people start to trust you. But then once you do one deal and you're really loud about it, about paying somebody back, you go from this category of every goddamn newbie investor wanting money to somebody who actually does what they say they're going to do. Somebody who is able to find deals, buy them with other people's money, refurbish them, and then pay those people back. Because you won't hear about any of our customers or clients who have been paid back because they're happy. Why would they go and preach to everyone? It's very rare. You tend to hear the bad ones. So the people who don't have as many sort of public reviews or public videos saying, yeah, these guys are good, no matter how many times I ask them, they generally tend to be the ones that are quietly raising money, paying people back, and thousands of pounds is changing hands at any one deal. And you can develop that sort of ecosystem, but you've got to start now. There's no point in starting 3 years at the end of a rent-to-rent portfolio that's just about to go kaput. And it went down very quickly. Sold all his deals. The other pair in London who had 50 rent-to-rents, and initially they were saying, yeah, we make £500 rent-to-rent. But then as they were getting bigger and they were taking on more staff, they were actually losing money and they ended up poorer overall. Whether that's them sourcing bad deals, who knows? But I think it's the model itself is poor. The only reason it's so popular is because trainers are able to sell it. It's an easy sell. And literally Vince, the guy, the circle that I'm in, is the only person I know who says don't do rent to rent. Why are you doing rent to rents? It's stupid. Get sourcing, get big lumps of cash, get your own assets, and then over time you can build wealth. I know it's more difficult and it's a pain, and most people don't want to hear it. There's quite a lot of aggression when you call people out and saying, don't do rent to rents. Yeah, well done, but it's not going to last. Just be prepared. It's a short-term thing. You need to go and get your own assets. And that's my take on it. I'd love to hear what you guys think, because I'm seeing so many sources say, oh, I source rent to rents, I source HMOs, I source rent to SA, and I think it's a short-term answer to a long-term problem. And you're never going to end up with true overall wealth long-term if you're having to constantly tread water, because you're still doing that, like rent to rents, you're exchanging time for money. And again, why do that? You might as well be in a job. Focus on making money work for you as opposed to exchanging your time for it. And then that's, if you just stick to that principle, you'll realize what are the sort of new gimmicks and what are the actual asset building wealth sort of. And I can guarantee you, any renter now, if you look in 10 years, just write this down, who, if you know some, compare them and then compare KML and Homo, compare us, and we will be in a much better position purely because we've stuck to the model of making your money work for you and investing it, rather than exchanging time for money. And rent to rents, you exchange your time for money. And I'm not saying it was very easy to build this model. It isn't. It's a complete pain in the ass. I've basically worked for free for 4 years and lived like a pauper. It's only really now that we begin to see some of the benefits. But what's the alternative? The alternative is just to continue doing what I'm doing. And I could have went down the rent to rent route, owned no property, owned 50 rent to rents, maybe had great cash flow and could potentially plug that into assets now. But I wouldn't have developed the skill of raising finance. I wouldn't have developed the skill of having sort of like a public persona where I get people approaching me for deals, and now I can very easily branch out into other businesses purely on the basis of that I've networked, I've managed to raise finance, I've managed to sell deals to people. So work for construction is ever forthcoming. I literally put a post up today about selling some Accor boards, and already we've sold 100 of the 900 that we have, like just for one post, no effort of marketing, purely by developing that skill of raising finance, which forces you to do so many other things that bleeds into every part of your business. It forces you to network, it forces you to connect with people, it forces you to find out what their needs are, find out what their wants are. It's the best skill that you can get for property is raising finance. And if you're not developing it, because you're going to have to at some point, now you're just wasting time and you're treading water. And that's my fault. That's why I don't think rent to rents are good, because it's an easy fix. They're quite easy to get, but the reward isn't that great. But the effort level is absolutely insane, because running HMOs initially, you have to do it for as cheap as you possibly can. And that means you're doing it evenings, you're doing it weekends, you're doing it when you don't work basically, and in your social time. And if you've got a load of rent to rent HMOs, you're not building your credit rating up, you're not building your portfolio with your lenders and your credibility to be able to get finance. Like the bridging deals that we can get now, purely because we've been lending for so long, it's nearly cheaper than private finance, which is crazy. So please don't buy into the hype. Stop doing bloody rent to rent. It doesn't make you a landlord. It makes you somebody who's managing a property for somebody. In other words, a letting agency. And if that's what you want to do, go for it. But don't kid yourself. You're not involved in property. You're not investing in assets. It's a short-term problem to a long-term answer. To build long-term wealth, and wealth that smashes the arse out of inflation, you need to own assets. And that's my opinion on it. Right, I'm going to head off now, because we had a bit of a busy day today. I had to move loads of Accor boards, and so I'm going to go frolic in a pool. No, I'm not, because the pool closes at 9. See, look, the life of a landlord. You always never have a bloody enough time. Ugh, never mind. I'll go to bed then. Good day.